A 7-day cruise can cost less than a single weekend in Las Vegas. For that price, you get thousands of meals cooked for you, a Broadway-style show most nights, multiple swimming pools, an ice rink or a surf simulator on some ships, a rock climbing wall, a full casino, and a crew member cleaning your room twice a day. Add up what a hotel that generous would normally cost, multiply it by 7 nights, and the math should not work. A land-based resort trying to match that level of service for a week would need to charge multiples of what the cheapest cruise cabin goes for. So where is the money actually coming from? The answer is not that cruising is secretly cheap to run. It costs a fortune. Feeding, housing, and entertaining several thousand people at once, 24 hours a day, for a week, is one of the more expensive things a company can choose to do. The answer is that the ticket you bought was never supposed to be the profitable part of the business in the first place. Think of the cruise ticket, the way a warehouse club thinks about its hot dog and soda combo at the food court. That combo has been priced the same for decades, and by most accounts, it barely breaks even or loses money outright once you count the bun, the meat, and the drink. The store does not sell it to make money on the hot dog. It sells it to get you through the door. Walking past pallets of everything else in the building, past the discounted electronics and the bulk cereal and the tire center, on your way to a checkout line where the hot dog was never the point. A cruise ticket works on the exact same logic, just stretched out over 7 days instead of one lunch stop. Across the industry, roughly 70 cents of every dollar a passenger spends goes toward that ticket. And that 70 cents mostly just covers what it costs to run the ship. Fuel for one of the larger vessels can burn through more than 150 tons a day. Add the crew, the food for several thousand people, the insurance, the port fees, and the fare is close to a break-even proposition before the ship even leaves the dock. Cruise lines will happily sell that ticket at a price that earns almost nothing, sometimes advertised at a fraction of what a comparable hotel stay would cost, because the ticket was never the product being sold for profit. It is the entry fee, priced deliberately low enough that almost nobody says no to it. The real product is everything that happens after you have already paid to get on board, and once you understand that, the ship itself starts to look less like a hotel and more like a floating shopping mall that happens to also move. Think of it that way from here on, because almost everything else about this business only makes sense once you picture it as a mall instead of a boat. The mall opens the moment that cheap ticket gets you through the door. Walk the ship for a single day, and the mall reveals itself floor by floor. Breakfast in the buffet is free, already covered by the fare, but the espresso bar a few steps away charges extra for anything beyond drip coffee. The pool bar sells a frozen drink in a souvenir cup priced well above what the same drink would cost at a bar back home. A photographer stationed at the gangway that morning will have a professional print waiting at guest services by dinner, framed and ready to buy, of a photo nobody remembers posing for. The main dining room is included. The steakhouse 2 decks up, with a shorter wait and a noticeably better cut of meat, runs another $40 or $50 a person. Wi-Fi, which costs the ship almost nothing to provide once the satellite connection is already paid for, is sold in tiers that can run more per day than the cabin itself. A daily gratuity charge gets added to your account automatically, covering the crew who clean your cabin and serve your dinner, and most passengers never think to adjust it even though every line will let you. None of these charges feel like a hard sell in the moment. Each one is small enough to wave off, easy enough to justify on a vacation. Multiply that logic across 7 days and several thousand passengers, and those small, easy charges are the entire profit margin of the voyage. Industry-wide, cruise lines have historically run net margins in the range of 15 to 19%, nearly double what a comparably sized hotel chain manages for exactly this reason. A hotel mostly just sells you the room. A cruise line sells you the room at a price that barely earns anything, then spends the next week selling you the mall built around it. Do the math on a single sailing, and the abstraction disappears. Estimates built from cruise line financial filings put average net profit per passenger, per week-long voyage, Somewhere around $200 to $300 once every cost has been stripped out. That number sounds modest until you multiply it by a ship carrying several thousand people at once, sailing on a schedule that barely pauses. A single large vessel can generate several $1,000,000 in profit on one trip, then do it again the following week, for years, with the hull itself functioning as close to a fixed cost as a business can have. None of that shopping mall would work nearly as well anywhere else. And this is the first hidden economic engine running underneath this whole business, even though it almost never gets its own explanation. Now the doors of the mall lock. Imagine locking 6,000 people inside the world's largest airport terminal for 7 days. Every coffee shop, every bar, every souvenir stand, every restaurant belongs to the same company. Nobody can leave to check whether the coffee is cheaper across the street, because there is no street, no rival terminal, no competitor 2 blocks over. That is exactly the position you are in the moment your ship pulls away from the dock. There is no competing steakhouse to walk to instead. No rival Wi-Fi provider undercutting the ship's price. No option to decide the drink package is too expensive and simply buy a cheaper beer somewhere down the road because there is no road. A normal business has to worry every single day about a customer walking out the door and choosing a competitor instead. A cruise ship, for one full week, does not have that problem at all. The competition disappeared the moment the gangway came up, and every price on board reflects that fact whether passengers consciously notice it or not. This is why a can of soda that would cost $1.50 at a corner store can run $3 or $4 on a ship, and why almost nobody complains loudly enough to change it. There is nowhere else to buy the soda. Compare that to almost any other vacation format, and the difference becomes obvious. A tourist staying at a beach resort can always walk 2 blocks to a cheaper restaurant, or skip the hotel spa in favor of a local massage place at half the price. That competitive pressure keeps prices honest, because the business knows its customer has options. A cruise ship spends 7 days deliberately removing every one of those options, one port stop at a time, and the pricing on board behaves exactly the way you would expect a business to behave once its customers have nowhere else to go. Here's where the economics become even stranger. You would assume a captive customer means the ship just charges everyone the same high price and calls it a day. It does the opposite. Cruise lines don't try to charge everyone the same amount. They actively avoid it because treating every passenger identically would leave money on the table from the passengers willing to spend far more, while pricing out the ones who would only ever pay the bare minimum. So the same mall sells 2 completely different memberships to 2 completely different customers, a strategy economists call price discrimination. The same 7-night itinerary on the same ship can be sold to one passenger for a heavily discounted inside cabin with no windows, and to another passenger down the hall for 10 times that price in a suite with a private balcony, a butler, and priority boarding. And both passengers are, technically, buying the identical week at sea. The same ports, the same shows, the same dining room menu. The ship is not really selling one product at different prices. It is selling dozens of slightly different experiences layered onto the same steel hull, precisely calibrated so that a family looking for the cheapest possible vacation and a couple looking to spend lavishly can both find something priced exactly at what they are willing to pay, extracting the maximum amount each type of customer can be talked into spending rather than settling for one price that undershoots what the big spenders would have paid. The same logic runs through the drink package tiers, several of them stacked at different price points depending on how many cocktails a passenger honestly expects to order in a day, and through specialty dining packages that bundle 3 restaurant visits at a discount for the kind of passenger who would have paid full price for each one individually anyway. Even the base ticket price itself moves constantly before the ship ever sails, the same way an airline seat does, rising and falling week to week based on how quickly a particular sailing is filling up, so that 2 passengers booking the identical cabin 2 months apart can end up paying noticeably different amounts for the exact same week. It shows up again in the loyalty program, where a passenger's 10th cruise unlocks perks and small discounts that a first-timer never sees. Not out of generosity, but because a loyal repeat customer has already proven roughly how much they are willing to spend, and the cruise line would rather keep that customer coming back than compete purely on price for someone who might walk away over a $10 difference. Increasingly, it starts even before the ship leaves the dock. in personalized offers built from data on what that specific passenger bought on their last sailing, timed to arrive in an inbox exactly when a booking is likely to convert into an upsell. It is not one ship selling one thing. It is one ship selling as many slightly different things as it can, at as many different price points as its passengers can be sorted into. At some point, cruise executives looked at this entire captive shopping mall model and asked an obvious follow-up question. The mall decides to own the parking lot. If passengers spend so much more once they cannot leave, what happens the moment they step off the ship into a foreign port where suddenly they can leave, wandering into whatever restaurants, taxis, and souvenir shops a local town happens to offer, with every one of those dollars flowing straight into somebody else's economy instead of the cruise line's own accounting? The mall, in other words, doesn't just want to own the store. It wants to own the parking lot too. The answer was to stop letting that happen and build an island where it couldn't. In 2019, Royal Caribbean spent $250 million transforming a small Bahamian island it had owned since the 1980s into something called Perfect Day at Coco Cay, an amusement park with a beach wrapped around it. This is vertical integration, the same instinct that leads an oil company to also own its own gas stations, or a movie studio to own its own theater chain, applied to a vacation. Instead of losing passenger spending to whatever port happened to be on the itinerary that day, the cruise line simply bought the port and then built a reason for passengers to want to spend the whole day there instead of wandering off to look for something cheaper nearby because there was nothing nearby to wander off to. Since it opened, ticket revenue on itineraries that include the island has grown roughly 48%, even as related costs climbed about 41%, a gap analysts point to as proof the investment did exactly what it was built to do. One research estimate puts the island's expected revenue for 2026 at around $600 million, from a single stretch of sand on top of whatever the ships themselves bring in. Carnival is now pouring $600 million of its own into a rival destination on Grand Bahama called Celebration Key, and Norwegian's smaller version, Great Stirrup Cay, is estimated to bring in closer to $80 million, a gap that shows how much the scale of the ships feeding the island actually matters. The newest class of vessel, carrying more than 7,000 passengers and crew combined, can now feed two of these giant ships into the same private island on the same day, which means the island runs on the exact same principle as the ship itself. Get an enormous temporary population onto a captive piece of land with a menu, and let the day take care of the rest. The government on the other side of that arrangement has started to notice. The Bahamas, where cruise passengers now make up the overwhelming majority of all visitors to the country, recently proposed new taxes aimed specifically at these private islands, including levies on the imported goods and premium add-ons, cabanas that can run several $1,000s a day, that these destinations depend on. The country's own prime minister has pointed out that visitor numbers have exploded while the tax revenue collected from those same visitors has not kept pace at all, essentially arguing that the vertical integration that made the cruise line so much money quietly cut the host country out of its own tourism boom. There's one more piece of vertical integration hiding in plain sight that most passengers never think to question. Why a company headquartered in Florida, run by executives who work in Florida, sailing ships mostly out of Florida, is legally based in Panama. The mall doesn't just own the parking lot, it even gets to choose which city taxes the business. A nearly century-old shipping provision exempts foreign-flagged vessels from U.S. corporate tax on income earned from operating a ship, as long as the ship's home country returns the same courtesy to American vessels. Carnival is incorporated in Panama. Royal Caribbean has been incorporated in Liberia since the 1980s. Norwegian is incorporated in Bermuda. Cruise lines noticed that nothing in that language stopped a floating resort from claiming the same exemption a cargo freighter did, and restructured their corporate identity around it. Between 2011 and 2015, Carnival reported roughly $7.25 billion in net profit, and paid a total of about $44 million in U.S. taxes across that entire stretch, a rate under 1%, against a corporate rate of 21% everyone else operating in the United States is legally required to pay. Roughly 4 out of every 5 ocean-going merchant vessels on Earth fly a flag of convenience for the same reason. So, cruise lines didn't invent this. They just built a far more visible industry on top of it, which is exactly why a cruise ship draws headlines a container ship never does. In 2026, a senior official in the Trump administration publicly floated closing that loophole outright, and shares of Carnival, Royal Caribbean, and Norwegian fell somewhere between 7 and 11% within hours of the comment, wiping out billions of dollars in market value over a single sentence. That reaction alone tells you exactly how much of this business is quietly resting on one piece of tax paperwork most passengers will never read. None of this, the loss leader ticket, the captive shopping mall, the price discrimination, the private islands, the tax structure, would matter nearly as much without one final advantage. It isn't another product. It's scale. The mall, quite simply, keeps getting bigger. A megaship in the newest class can cost well over $2 billion to build, a genuinely enormous number, but the cost per passenger actually falls as the ship gets bigger because a crew of a given size, a kitchen of a given size, and a casino of a given size can serve far more people on a 7,000 passenger ship than on one carrying half as many, without needing to grow proportionally. A ship carrying twice as many passengers does not need twice as many chefs, twice as many entertainers, or twice as many casino floors. Since a lot of the fixed overhead, the bridge crew, the navigation systems, the entertainment production costs, barely changes at all whether the ship holds 3,000 people or 7,000. This is the same logic that makes a bigger factory cheaper per unit than a small one, and it is precisely why cruise ships have grown roughly tenfold in capacity since the industry's early decades. Every rock-climbing wall and ice rink bolted onto the top deck is, in part, a way to justify building the ship bigger in the first place, since a bigger ship spreads its enormous fixed cost across more paying passengers and more onboard spending in the exact same voyage. The economics reward size so heavily that the entire industry has spent 3 decades in an arms race to build the next slightly larger ship because the math genuinely gets better every time the passenger count goes up, right up until a ship gets so large that only a handful of ports on Earth can actually accommodate it, which is its own kind of ceiling on how far this particular strategy can keep scaling. Even that ceiling has become part of the business, since a port capable of handling the newest megaships now has real negotiating leverage over which cruise line gets priority docking, turning a handful of harbors around the world into unexpected bottlenecks in an industry otherwise built entirely around removing bottlenecks wherever it finds them. Every one of these advantages, the loss leader pricing, the captive market, the price discrimination, the private islands, the tax arbitrage, the economies of scale, rests on one assumption holding steady: that the ship keeps moving and passengers keep boarding it. Then, in March of 2020, the greatest shopping mall in the ocean suddenly had no customers, and no way to open its doors even if it had. That assumption broke completely all at once for every cruise line in the world simultaneously, and it is worth treating as exactly what it was. Every business model, no matter how well engineered, eventually faces one stress test it did not design for. The Centers for Disease Control issued a no-sail order originally meant to last 30 days. It stretched past a year, with 3 separate extensions before ships were finally cleared to sail again in the summer of 2021. Carnival's revenue, which had been running near $20 billion annually before the shutdown, collapsed by more than 99% in some quarters, falling from $6.5 billion in a single quarter of 2019 to just $31 million in the same quarter the following year. Every economic advantage this business had spent decades building, the loss leader ticket that filled the ship, the captive market that made onboard spending so profitable, the private islands. None of it could generate a single dollar of revenue with the fleet sitting empty at anchor and no legal way to fill a single cabin. The company burned through roughly $650 million in cash every single month regardless, since crew payroll, ship maintenance, and debt payments do not pause just because the doors are closed, and eventually sold off 19 ships just to slow the bleeding. Carnival alone raised nearly $19 billion in new debt and equity within the first year of the shutdown, and still posted a net loss of more than $10 billion for the year. By the time ships were finally cleared to sail again, total debt had roughly tripled compared to before the pandemic, climbing past $34 billion. At one especially grim point in 2022, a major Wall Street bank warned that in a sufficiently severe scenario, the shares could realistically fall to zero. Every advantage this business model had built, the lost leader ticket, the captive customer, the vertical integration, the tax structure, the economies of scale, turned out to depend entirely on one variable none of them controlled: whether a government would let the ship leave the dock. When that variable hit zero, so did almost everything else, all at once, for every operator on Earth. It came back anyway, and arguably came back stronger, which says something about how durable this particular economic machine actually is. Royal Caribbean's most recent quarters have shown load factors above 100%, meaning ships are sailing with more people aboard than their advertised capacity technically allows, filling extra berths in cabins that used to sail half empty. Margins at the larger operators have climbed back into the high 30s as a share of earnings, driven almost entirely by the parts of the business that have nothing to do with the ticket price, the exact same onboard economy that had sat dark and unprofitable for over a year. Spending booked before the cruise even starts now makes up more than half of all onboard revenue at some companies, meaning the captive market pricing increasingly begins before passengers ever set foot on the ship at all, locked in against a booking that already has a credit card attached to it. Repeat passengers, the ones who already know exactly which extras they will want before they board, make up a growing share of every sailing, and they spend noticeably more per trip than first-timers do, which means the loyalty side of the price discrimination strategy is quietly becoming one of the most reliable revenue lines in the entire recovery. Cruise ships do not make billions of dollars because they sell vacations. They make billions because they have mastered a specific, repeatable economic formula, one that has nothing to do with the ocean and everything to do with pricing. Price the ticket at almost no profit to get people through the door, the same instinct behind every discounted rotisserie chicken and loss-leading milk carton in a grocery store. Lock the doors of the mall once they're inside, since a customer who cannot leave behaves nothing like a customer who can. Charge different passengers different amounts for the exact same week at sea, extracting whatever each one is actually willing to pay instead of settling for a single price. Buy the parking lot so the spending never leaves the family. The same logic that puts a gas station next to an oil refinery. Choose where the mall pays its rent, registering the company wherever the tax bill nearly disappears. And keep making the mall bigger every few years because the economics of scale make the whole machine cheaper to run per person every time the passenger count climbs. Remember that math from the very beginning, the one that shouldn't have worked. A week of meals, shows, pools, and a made-up bed every night for less than a weekend in Las Vegas. It was never a magic trick. That 7-day vacation was never really just a vacation. It was one of the most carefully engineered economic machines in all of travel, one where every buffet, every balcony, every cocktail, and every water slide exists for exactly one reason: because it makes the business model work. By the end, what looked like a cruise ship was never really a ship at all. Cruise ships aren't hotels that float. They're shopping malls that learned to sail.